Ladies and gentlemen, let me share a way of thinking that has guided my entire life as an investor. Wealth is not built by chasing noise. It is built by understanding cycles, by recognizing imbalances, and by positioning yourself before the crowd sees what is coming. Today, I want to talk about silver, not as hype, not as a short-term trade, but as a strategic asset in a world that is changing faster than most people realize. Economic cycles are not random events. They are structured patterns that repeat because human behavior, incentives, and limitations do not change. Across centuries, across different political systems, and across levels of technological advancement, societies have followed the same path. Debt grows during good times, optimism increases, risk is ignored, and leverage expands. Governments borrow to stimulate growth. Businesses borrow to expand, and individuals borrow to maintain lifestyles. For a period, this feels sustainable, even prosperous. Asset prices rise, confidence builds, and people begin to believe that this time is different. But it never is. As debt continues to expand faster than real productivity, the system becomes fragile. Eventually, the burden of servicing that debt becomes too heavy. At this stage, policymakers face limited choices. Rising taxes or cutting spending is politically painful. Allowing defaults can destabilize financial systems. As a result, the most common response is currency debasement, printing money, lowering interest rates, and using inflation as a hidden tax. This process reduces the real value of debt, but simultaneously erodes the purchasing power of savers and wage earners. History offers countless examples, from the Roman Empire reducing the silver content of its coins, to European monarchies inflating currencies to fund wars, to modern economies using quantitative easing. The pattern remains consistent. The names change, the tools evolve, but the underlying mechanism stays the same. When trust in money weakens, people instinctively move toward assets that cannot be printed. This is where real assets enter the cycle. Gold and silver have survived not because of tradition, but because they solve a recurring problem, preserving value, when paper promises fail. During late-stage debt cycles, financial assets that depend on confidence, stocks, bonds, and currencies, become vulnerable. In contrast, tangible assets with intrinsic value begin to regain attention. This shift does not happen overnight. It builds quietly, often while prices remain suppressed and sentiment remains dismissive. Most investors fail at this stage because they extrapolate the recent past into the future. If inflation has been low, they assume it will stay low. If currencies have been stable, they believe stability is permanent. But cycles turn precisely when confidence is highest and preparation is lowest. By the time inflation is obvious and currency weakness is widely discussed, the opportunity to position early has already passed. Silver plays a unique role in this recurring pattern. Historically, it has functioned as money for everyday transactions while also serving as a store of value. When currencies weaken, silver tends to reassert its monetary role. Unlike purely financial instruments, it does not rely on a counterparty's promise. Its value is not dependent on a central bank's credibility or a government's fiscal discipline. It exists outside the system, which is precisely why it matters most when the system is under stress. As economic cycles approach their later stages, the gap between financial reality and official narratives widens. Growth slows, inequality rises, and policymakers double down on stimulus. This is the point where wealth quietly shifts. Those who understand cycles are not reacting to headlines. They are responding to structural imbalances that have been building for years. The key lesson is not to predict exact dates or price levels. The lesson is to recognize where you are in the cycle and what typically performs well at that stage. Throughout history, assets tied to real value, not promises, have protected and often increased purchasing power during these transitions. Silver, because of its monetary history and tangible nature, has repeatedly benefited when cycles reset. Economic cycles always repeat because the constraints that create them, debt, incentives, and human psychology, are permanent. Ignoring them does not stop them. Understanding them, however, allows you to position intelligently before the crowd realizes that the environment has changed. Silver occupies a rare and powerful position in the global system because it is both a monetary metal and a critical industrial resource. This dual role is what makes it fundamentally different from many other assets and why it becomes especially important during periods of economic transition. Throughout history, silver was not just a store of wealth, but a medium of exchange used by ordinary people in daily life. Long before complex financial systems existed, silver functioned as trusted money because it held intrinsic value, was divisible, and could not be created at will. That monetary legacy has never disappeared. It has only been temporarily overshadowed by modern fiat currencies. At the same time, silver is indispensable to modern technology. It is one of the most conductive metals on Earth, making it essential for electrical and electronic applications. From smartphones and computers to medical devices and water purification systems, silver is embedded deep within the infrastructure of modern civilization. Unlike gold, which is primarily held for investment in jewelry, much of the silver consumed industrially is not easily recoverable. Once used, it is often dispersed in tiny quantities, effectively removing it from circulation. This creates a structural imbalance that most people overlook. Industrial demand for silver is not driven by investor sentiment, it is driven by necessity. As the global economy moves toward electrification, automation, and digitalization, silver consumption increases regardless of market conditions. Solar panels require silver paste for conductivity. Electric vehicles use significantly more silver than traditional cars. Power grids, charging infrastructure, and data centers all depend on silver's unique properties. These trends are not cyclical fads, they are long-term structural shifts. While demand grows steadily, supply does not respond as easily. Silver is rarely mined on its own. The majority of global silver production comes as a byproduct of mining for other metals such as copper, lead, and zinc. This means silver supply is largely dependent on the economics of entirely different markets. Even if silver prices rise, production cannot quickly increase unless those other metals are also profitable to mine. This creates a lag in supply response that can persist for years. On the monetary side, silver's role becomes more visible during times of financial stress. When confidence in paper money declines, investors historically turn to tangible assets. Gold usually attracts attention first because of its reputation as a central bank reserve asset, but silver often follows with greater volatility. Because silver's market is smaller and more thinly traded, shifts in demand can lead to disproportionately large price movements. This is why silver has a history of sudden and powerful rallies during late-stage economic cycles. The combination of monetary demand and industrial necessity creates a unique form of support beneath silver's value. Even when investment demand is weak, industrial consumption continues. Even when industrial growth slows, silver's monetary appeal can increase. Few assets benefit from this kind of dual demand structure. Most commodities depend primarily on economic growth, while most monetary assets depend on confidence. Silver benefits from both forces at different times. Another critical aspect is affordability and accessibility. Silver is far more accessible to individuals than gold. This matters because during periods of monetary instability, participation broadens. When people seek protection outside the financial system, silver often becomes the entry point. That widespread participation can amplify demand very quickly, especially when supply is already tight. In a world facing energy transitions, rising debt levels, and persistent currency debasement, silver's dual role becomes increasingly important. It is not simply a hedge or a speculative bet. It is a material that modern systems cannot function without, and a form of money that has survived every monetary experiment in history. This combination makes silver uniquely positioned when economic and financial pressures converge, as they so often do at turning points in major cycles. The relationship between supply and demand is the foundation of every market, and silver is no exception. What makes silver different, however, is that its supply and demand dynamics are quietly moving in opposite directions at the same time. Demand is expanding for structural, long-term reasons, while supply remains constrained by factors that are difficult, expensive, and slow to change. This tension builds beneath the surface, often unnoticed, until it reaches a point where prices must adjust sharply to restore balance. On the demand side, silver is becoming increasingly essential to the modern world. The global push toward renewable energy is one of the most powerful drivers. Solar power, in particular, relies heavily on silver for its unmatched electrical conductivity. Each solar panel uses small amounts of silver, but when multiplied across millions of panels installed every year, the total demand becomes enormous. Governments around the world have committed to aggressive renewable energy targets, and these commitments translate directly into sustained silver consumption, regardless of short-term economic fluctuations. Electric vehicles add another layer to this demand. Compared to internal combustion engine vehicles, electric cars require significantly more silver due to their complex electrical systems, batteries, and control units. As nations phase out traditional vehicles and invest in charging infrastructure, silver demand increases not only in the cars themselves, but also in the networks that support them. This demand is not speculative. It is built into policy decisions and long-term industrial planning. At the same time, silver plays a vital role in electronics, medical technology, and defense systems. The growth of data centers, artificial intelligence, and advanced medical equipment further expands industrial consumption. Unlike many raw materials, silver often cannot be substituted without compromising performance. Its unique physical properties make it difficult to replace, ensuring that demand remains resilient even when prices rise. While demand trends upward, supply tells a very different story. Silver mining is constrained by geology, economics, and time. New mines take many years, sometimes decades, to discover, permit, finance, and develop. Environmental regulations, political instability, and rising costs add further obstacles. Even when prices improve, these barriers prevent rapid increases in production. Adding to the challenge is the fact that most silver is produced as a byproduct of mining for other metals. This means silver supply is largely disconnected from silver prices. If demand for copper or zinc slows, silver output can decline even if silver itself is in high demand. This structural dependence limits the market's ability to respond to shortages in a timely manner. Recycling offers only partial relief. Much of the silver used in industrial applications is embedded in products in such small quantities that recovery is uneconomical. As a result, large amounts of silver are effectively lost to the market each year. This gradual erosion of above-ground supply tightens availability over time, even as consumption grows. When such imbalances develop, markets eventually force a correction. Prices exist to ration limited resources. When supply cannot keep up with demand, the only mechanism left is repricing. This process often happens suddenly because markets tend to ignore slow, building pressures until a tipping point is reached. Once that point arrives, even small increases in demand or disruptions in supply can trigger disproportionate price movements. Historically, silver has demonstrated this behavior repeatedly. Long periods of stagnation or underperformance are followed by sharp, rapid advances when the imbalance becomes impossible to ignore. These moves are often driven not by speculation alone, but by the urgent need of industrial users and investors to secure limited supply. The collision of rising demand and constrained supply is not a theoretical risk. It is already underway. The longer this imbalance persists, the greater the pressure on price. When repricing occurs, it is not gradual or polite. It is swift, volatile, and often surprising. This is why silver has the potential to move dramatically when structural forces finally overpower market complacency. One of the most misunderstood ideas in investing is the belief that meaningful wealth requires large amounts of capital. In reality, some of the most powerful opportunities in financial history have come from small, well-placed positions taken at the right time. This is what creates asymmetric outcomes, situations where the potential upside is many times larger than the downside. Silver represents this type of opportunity, not because it guarantees success, but because the balance between risk and reward is unusually skewed. Asymmetry exists when an asset is undervalued, widely ignored, and positioned at the intersection of multiple favorable forces. In such cases, the downside is often limited by fundamental value, while the upside can expand dramatically if conditions shift. Silver fits this profile because it is priced like an abundant commodity, yet behaves like a strategic metal during periods of economic stress. This mismatch between perception and reality is where opportunity lies. Small exposure matters because timing matters more than size. When markets are early in a revaluation process, modest positions can benefit disproportionately. Investors who wait for clarity usually pay a much higher price, both literally and figuratively. By the time an opportunity is obvious, the asymmetry has already collapsed. Risk increases while potential reward shrinks. Early positioning, even at a small scale, allows investors to participate in the repricing without taking excessive risk. Silver's market structure amplifies this effect. The silver market is relatively small compared to other asset classes such as equities, bonds, or even gold. Because of this, incremental increases in demand can have an outsized impact on price. When new buyers enter the market, whether industrial users, investors, or institutions, the supply cannot easily absorb the pressure. This creates sharp price movements that reward those already positioned. Another factor that enhances asymmetry is silver's volatility. Volatility is often viewed as a negative, but in asymmetric opportunities, volatility is a feature, not a flaw. When an asset is undervalued, volatility tends to work in favor of the investor over time. Sharp upward moves often occur in compressed time frames, while corrections are usually limited by underlying demand. This creates a payoff structure where patience can be rewarded suddenly and significantly. Asymmetric exposure does not require all or nothing decisions. Intelligent investors think in terms of balance, not bets. Holding a measured amount of silver within a diversified portfolio can improve overall risk-adjusted returns. If silver underperforms, the impact is limited. If it revalues sharply, the contribution can be meaningful. This is the essence of asymmetric positioning: limited downside, meaningful upside. Psychology plays a critical role here. Most people are uncomfortable owning assets that appear stagnant or unpopular. Silver often goes through long periods of neglect, which discourages participation. Yet these are precisely the conditions under which asymmetry builds. When sentiment is low and expectations are minimal, it does not take much change to alter the narrative. A shift in inflation, currency confidence, or industrial demand can rapidly transform perception. Historical examples reinforce this principle. Assets that deliver the largest gains are rarely those that everyone already loves. They are the ones that quietly accumulate pressure beneath the surface. Silver has repeatedly demonstrated this pattern. Long periods of consolidation, followed by explosive moves when conditions align. Those who had small but strategic exposure benefited far more than those who tried to react later. The key insight is not about predicting exact outcomes. It is about understanding probability distributions. When the potential reward significantly outweighs the risk, rational investors allocate some capital, even if the position seems modest. Over time, these asymmetric decisions compound into meaningful results. Silver, viewed through this lens, is not a speculative gamble, but a calculated response to an environment where imbalance creates opportunity. Relative valuation is one of the most reliable tools for understanding whether an asset is expensive or cheap. And in the precious metals space, the gold to silver ratio has long served as a powerful benchmark. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Over centuries, despite changes in monetary systems and technology, this ratio has shown a clear tendency to move within historical ranges and then revert when it reaches extremes. Today, that ratio remains significantly stretched, signaling that silver is undervalued relative to gold. The gold to silver ratio has averaged far lower than where it stands in many modern periods. For long stretches of history, particularly when both metals functioned as money, the ratio moved within a much tighter band. When the ratio rises sharply, it usually reflects a period of fear, financial stress, or strong institutional preference for gold. In these moments, gold attracts capital as a perceived safe haven, while silver is temporarily ignored. This divergence, however, has never been permanent. Mean reversion is a fundamental principle of markets. Extreme valuations create incentives that eventually pull prices back toward balance. When silver becomes too cheap relative to gold, industrial users increase purchases, investors seeking value rotate in, and supply constraints begin to matter more. Over time, these forces compress the ratio, not by gold falling dramatically, but more often by silver rising faster. What makes silver particularly interesting during ratio reversals is the speed and intensity of its moves. Silver has a much smaller market than gold, and it lacks the same level of central bank ownership. As a result, when capital begins to shift, silver prices can adjust violently. History shows that during periods when the gold to silver ratio falls sharply, silver often delivers multiples of gold's percentage gains in a relatively short period. Another important aspect is perception. Gold is widely recognized as a monetary asset held by central banks and institutions. Silver, despite its monetary history, is often dismissed as an industrial metal or a secondary store of value. This perception gap contributes to prolonged undervaluation. However, when economic conditions challenge confidence in currencies or financial systems, silver's monetary role re-emerges quickly. At that point, the ratio does not drift, it snaps. The current environment amplifies this dynamic. Rising debt levels, persistent inflationary pressures, and geopolitical uncertainty continue to support gold. At the same time, silver faces growing industrial demand from energy transition and technology. This combination is unusual because it supports both sides of silver's identity simultaneously. In past cycles, silver often benefited either from monetary stress or from industrial expansion. When both occur together, the reversion can be especially powerful. It is also important to understand that ratio reversion does not require extreme assumptions. Even a move back toward historical averages implies substantial upside for silver relative to gold. Investors do not need to predict a crisis or a dramatic collapse in gold prices. They only need to recognize that extreme relative valuations rarely persist indefinitely. Psychologically, ratio analysis helps remove emotional bias. Instead of asking whether silver will rise in absolute terms, the question becomes whether silver should remain this cheap compared to gold given its role and demand. When viewed this way, the imbalance becomes clearer and easier to act upon. The moments when the gold to silver ratio was highest have often preceded some of silver's strongest performance periods. These moments were uncomfortable because silver felt irrelevant at the time. Yet discomfort is often the price of opportunity. Relative valuation does not provide exact timing, but it does highlight probability. When probabilities are skewed by extreme ratios, silver's potential to outperform gold increases significantly making it a compelling strategic consideration in a balanced portfolio. Preparation is the defining line between those who preserve and grow wealth during major economic transitions and those who struggle to keep up. Financial markets reward foresight far more than reaction, yet most participants operate in reverse. They wait for confirmation, for headlines, for consensus. By the time certainty arrives, prices have already adjusted and the opportunity has passed. This pattern repeats because human psychology prefers safety over foresight, even when that safety is an illusion. Economic shifts do not announce themselves clearly at the beginning. They emerge gradually through small signals: rising debt, persistent inflation, tightening supply chains, weakening currencies, and growing policy intervention. Individually, these signs are easy to dismiss. Collectively, they point to structural change. Prepared investors study these signals and act while uncertainty is high and conviction is low. Reactive investors wait until outcomes feel obvious, at which point risk is highest and reward is lowest. Silver fits naturally into a preparedness mindset. It is not an asset designed to perform in perfectly stable environments. It performs when systems are stressed, when imbalances matter, and when trust in paper promises weakens. Owning silver before these conditions fully develop is a form of insurance. Insurance is never attractive when everything appears calm, yet it becomes invaluable when conditions change. The concept of preparation is closely tied to cause and effect. Markets do not move randomly. They respond to pressures that build over time. When governments run persistent deficits, the long-term effect is currency debasement. When real interest rates remain negative, savers are pushed toward hard assets. When industrial demand outpaces supply, prices must adjust. Prepared investors focus on these causes rather than the short-term effects reflected in daily price movements. Reaction, by contrast, is driven by emotion. Fear and greed dominate decision, making one's trends become visible. Investors buy silver after it has already risen sharply because they fear missing out, not because the fundamentals have improved. This behavior often leads to poor outcomes, as late entrants absorb volatility without capturing the full upside. Preparation avoids this trap by establishing positions before emotional pressure enters the market. Another advantage of preparation is flexibility. Those who position early are not forced to act under stress. They can hold, rebalance, or reduce exposure as conditions evolve. Reactive participants, on the other hand, are often compelled to make decisions quickly, driven by headlines and market swings. This urgency increases the likelihood of mistakes. History reinforces this lesson. Every major transfer of wealth, whether during inflationary periods, currency crises, or commodity revaluations, has favored those who anticipated change rather than those who chased it. Silver's strongest advances have typically begun when it was widely ignored, not when it dominated financial news. By the time silver becomes a mainstream topic, its most asymmetric phase is usually over. Preparation also requires patience. Structural shifts do not conform to short-term timelines. There can be long periods where prepared positions appear unproductive. This tests conviction and discipline. Yet these quiet phases are often when pressure is building beneath the surface. Prepared investors understand that inactivity in price does not mean inactivity in fundamentals. Preparation is not about predicting exact events or timing markets perfectly. It is about aligning with probability. When multiple forces point in the same direction, monetary stress, industrial demand, constrained supply, the probability of repricing increases. Acting on that probability before it becomes consensus is what separates strategic investing from speculation. Those who prepare accept uncertainty as a cost of opportunity. Those who react pay a much higher price in missed gains and increased risk. In periods of economic transition, this difference is decisive. Silver, when held with foresight rather than urgency, becomes not just an asset, but a strategic position in anticipation of change.